Most high-income professionals believe they have a diversified portfolio. They own index funds, retirement accounts, real estate, and perhaps a business or private investments. On paper, that looks diversified. But beneath the surface, many of those assets may still depend on the same economic forces: rising markets, available credit, strong consumer demand, and continued economic growth. In other words, you can own many investments and still have only one risk. That creates an important question for anyone pursuing financial independence. Is your financial freedom truly resilient, or does it depend on the market continuing to behave the way it has over the past decade? Today's episode explores whether algorithmic trading can provide a source of returns that behave differently from traditional investments. My guest, Jeff Sekinger, is the founder of NURP, a company that licenses algorithmic trading strategies that clients can connect to their own brokerage accounts. We discuss the concentration risk hiding inside many position and high-income portfolios, the differences between algorithmic trading, private credit, real estate syndications, and traditional funds, and why liquidity, custody, and risk-adjusted returns may matter just as much as headline performance. We also examine where a strategy like this might fit within an established portfolio, and equally important, where it does not belong. This episode is sponsored by NURP. The performance figures discussed are provided by NURP and should be independently verified. Algorithmic trading involves substantial risk, including the loss of principal, and past performance does not guarantee future results. This conversation is educational and is not financial, investment, tax, or legal advice. The goal of this episode is not to tell you what to invest in, it's to help you ask a better question. Are you merely accumulating more assets, or are you intentionally building a portfolio capable of protecting the financial freedom you work so hard to achieve? Hey guys, welcome to another episode of the Financial Freedom Podcast. I've got Jeff Sekinger from NURP, an official sponsor of the show. Really happy to have him on. Jeff, welcome.
Thank you so much. I'm excited to be here.
Briefly introduce yourself and we'll dive into the questions.
32 years old. I live here in Miami, Florida. I grew up in Ohio, went through the traditional education system and got my finance degree and worked for the largest bank inside the United States in asset management. Realized that I was just much more interested in alternatives. So I've started 3 different finance brands that are all around investing in some way, shape, or form, primarily in alternatives. One of the brands is named NURP, which is NURP. It's a software company that licenses trading strategies for higher net worth individuals that they can run in their own accounts. Excited to talk more about that.
We have a physician and high income earners. How can NURP help with problems and solutions that they're seeking for you?
We've had quite a few medical professionals work with us. We've had over 3,500 clients. Just to be clear, we've been in business for over 4 years. Most investors that are coming to us want something that's different. They've got real estate, they've got their business, they've got stocks in their portfolio. And a lot of times there's other people managing that for them, or they're just in passive index funds. So they're like just watching it grow over time. It can be a little bit boring. And some people like to have more control and also be in something maybe a little bit more exotic, a little bit more alternative that has a potential to outperform the rest of their portfolio. If you look at study modern portfolio theory, it talks about diversification and specifically diversification with assets that are uncorrelated to each other. And our product provides a very highly uncorrelated exposure to what traditional assets that you typically have in your portfolio. People are just looking for that diversification and looking for something a bit more exciting that has the potential to outperform the rest of their investments.
You've built 3 different financial companies. Most of your time has been spent building Orca Capital, the digital asset hedge fund, now NURP. What's the difference between these 2 businesses? What's the common problem you're solving for your clients in addition to uncorrelated assets?
Orca is a hedge fund, a regulated hedge fund that only works with accredited and up. I mean, one of our funds is only QEPs, which means that you have to be 5 million or above as far as net worth goes. I don't make the rules, the United States does. We have to abide by those. NURP is a way that you can get institutional exposure as far as institutional trading exposure in your portfolio without giving up custody to another company. The investors in Orca Capital, they're a limited partner of the fund. They have to send money to our bank account, which we put onto the exchanges and deploy our strategies. With inside of NURP, we're giving the licensing technology to different types of trading strategies they can run in their own account. So they remain custody. They typically use a third-party broker, but we have nothing to do with the broker and we don't work with the brokers in any way. They connect our software to their own brokerage account and can deposit and withdraw at any given time, change certain risk parameters. So they're more in control of the investments. And Orca does some things that NURP does, and NURP does things that Orca doesn't. They're not the same exact vehicles whatsoever. It's a different way to invest your money in alternatives.
One thing that's a common theme among a lot of sponsors that are coming onto the show is having regular individuals, retail, have access to what the wealthy get to do. You mentioned QEP and accredited. For an audience that's spent years trying to access what the rich do, walk us through the thesis behind making this accessible outside the accredited world.
I saw a huge gap. I was at that point in my life too, where I wasn't accredited and I wasn't QEP. And there's a huge gap of people that are worth 500,000 or million or 2 million. They're not getting the exposure to a lot of different vehicles, people that are in the ultra high net worth class of and Goldman Sachs or Morgan Stanley. They have a completely different list of deal flow and oftentimes different products that you wouldn't be able to get. The reason is because a lot of those times you're giving up the custody of your money. When you give up the custody to a third party to invest into a business or another investment vehicle, a lot of the times that is highly regulated. If you're taking the technology and using it in your own brokerage account, you have the ability to use exotic strategies in your own portfolio without necessarily giving up custody and without having to meet certain criteria as far as net worth goes. That was the main reason. There's just a huge gap in the market of people that are doing well professionally. They already have an investment portfolio built up, but they have not really done much of anything else, or they don't meet certain standards to get access to different types of products.
My people specifically, doctors chasing financial freedom, they're a particular kind of investor. They're actively pursuing financial independence. They're not passive about it. When they reach out to NURP, what's the most common blind spot in how they've built their portfolios?
They're concentrated in one thing. They've got all of their money in the stock market, or they've got all of their money in their business. When one of those things starts to go wrong, they've got one point of failure. It's fun when it's going well. When it's not going well, it can be devastating. Where we come in is partitioning off a smaller piece of a portfolio. Generally, people will look at a financial advisor, for example. It depends on the client they're talking to. Obviously, how much money they're making, their risk tolerance. Between 1% and 20% of a portfolio could go into alternative-based investments. That's the solution that we're providing. We're a piece of an overall portfolio to help people diversify. I mentioned modern portfolio theory. I highly suggest everyone look up what that term means, understand the efficient frontier, which is there's an optimal way to build an investment portfolio. A lot of people are very good at the core piece of the portfolio, which I think is the most important thing. It's like you got stocks, bonds, real estate, basic traditional investments. Oftentimes, when they start to get over a certain wealth level above $1 million, they don't take the metric bets with a smaller piece of their portfolio that are uncorrelated to the rest of their assets that could give an overall higher risk adjusted return in their portfolio. Those are things you'll understand deeper when you go look up those terms that I just mentioned. That's the position that we play in a portfolio, is that more speculative piece of a portfolio that gives you control and gets your feet wet into alternatives.
The standard playbook is max out 401k, buy real estate, hire an advisor. For someone whose actual goal is financial freedom, not just comfortable retirement at 65, what's broken about that playbook in 2026?
I think the past 20 years, the stock market has just been going up. We've had one bear market in 2020, obviously 2020 because of the virus, but that was very short-lived. That was a V-shaped recovery. If you go look at the stock market over long periods of time, generally it's up for 15 to 20 years and it's sideways for 10 to 15 years. And we haven't experienced a sideways chop of 10 to 15 years, almost 20 years. So I do think we're starting to come towards the end of a parabolic move, which is really just what markets have really done since inception. If you look over the past 120 years, again, they go up for 15 to 20 years, then go sideways for 10 to 15 years. The cycle repeats pretty consistently. So people are just getting very comfortable and very concentrated in their 401ks and retirement plans, and they're not really finding different types of vehicles that still can produce positive results, even if we do go into a sideways market for 10 years, or we head into a bear market, another 50% drawdown like we experienced in 2001 and 2009. So I think that piece is somewhat broken. And also, a lot of times you're limited on the types of investments that you can make in your 401k. I think just the concentration is just very easy for that to occur. And then again, when you get to that point when another 2009 or 2001 type bubble does occur, it's really painful and it takes a lot of wind out of your sail. And especially if the market doesn't recover like in 2 months, like it has over the past 5 years, every time we have a dip. So eventually that steam will run out. I don't know exactly when. I don't think really anyone does, but I just think the 401k naturally pushes you into concentration risk. And more of the indexes, which is primarily what you invest into in the 401k, we're getting more and more concentration just in the indexes in the top magnificent 7 companies that are the largest companies. I would say that's probably the biggest thing that's broken there.
A lot of listeners hold real estate. You mentioned index funds, maybe business. Where does an algorithmic strategy like NURP actually fit inside a diversified portfolio, and where does it not belong?
I would start with the first one. Where does it not belong? I would say it doesn't belong to someone that doesn't want to take on risk, because it's anything that's alternative is going to typically carry some more risk. Anyone that just wants to coast by just wants to buy treasury bonds and keep cash under their mattress. This is probably not the thing for you, which is okay. Everyone has a different strategy, different risk tolerance. For someone that does want things that are different, more exotic, can potentially outperform significantly the rest of their portfolio, this is also something that you can try. It'll be cool to track that. Anyone listening to this podcast can test it as well. We have a core strategy that, for example, just trades gold, and it is outperforming gold by over 10 times with even a smaller drawdown since we've had the account live 15, 16 months ago. It can have significant impact, positive impact on the portfolio. And again, it can, because it's so uncorrelated, because it's betting on gold going down as well. It's not just buying gold and waiting for gold to go up. When gold starts to have momentum to the downside, it starts betting on the gold prices going down. So it has the opportunity to make money even when gold is crashing in price. And that's really the secret sauce to market neutral type performance. There's a guy named Jim Simons that ran the Medallion Fund. There's a whole book written about him called The Man Who Solved the Market, but he averaged 66% a year for 30 years. Now, what was he doing? He was running trading algorithms in a fund, obviously pretty much on the highest level possible, because he's the most successful money manager of all time that most people haven't heard about. But that's our goal, is to provide, obviously we're not Renaissance technology, we're not Jim Simons, but we are deploying the same types of technology in order to have more market neutral exposure in our portfolios. That's our goal. And I would say that's where it would fit in, is someone that's like, okay, they understand they've already got a portfolio that's built. They've got some real estate, they've got some stocks, bonds, whatever it may be. And they are partitioning off a smaller piece of their portfolio to put into an algorithmic strategy to see if they can add value to their overall portfolio.
You reference gold. You talk about Midas specifically. What is it? Gold has had a strong run. We hear about it constantly as an inflation hedge. What does your algorithm do with gold that simply holding physical gold or ETF doesn't?
Since we started the live account of Midas, this is just from February of 2025 until May of 2026. This strategy is up 517% on a live account. We've had that verified by 2 different third parties as well. Gold over that same period of time is up 51.31%. So that's February of 2025 until May of 2026. So it's outperforming by more than 10 times. And then the drawdown, which is how much the equity has actually come down from the balance of the account, is slightly less than gold's max drawdown. It's at a 26.4 and gold was almost at a 27%. It has had significant outperformance of gold. And again, that's because it's betting on prices going down on gold. So when it finds an opportunity, it spots certain opportunities, certain setups on the price of gold. It's mainly trading momentum. So when you've got really strong momentum in price going up or down, it has certain indicators built into the technology. And when the gold price behaves in a certain way, it'll, bet short, which means bet on prices going down. And when gold's going up, it'll bet on prices going up. And then it has risk management built in on every trade. So it's got a stop loss built in, and it trails that stop loss up or down, depending on which way that it's betting. So it's more of a market neutral type performance because you still have the ability to produce positive returns even when gold is dropping. And that's exactly what we're seeing this year. Strategy's up over 70%. And now over the past week or two, gold is actually negative on the year. So yeah, that's the major difference. It just gives you a completely different dynamic of exposure to technically the same type of asset. So you can buy and hold, probably do pretty well over a long period of time. I like gold as an overall asset, but there's no denying that, at least with our live performance, that we have significantly outperformed gold even during one of the strongest bull markets it's had in a while.
A lot of doctors get pitched syndications. That was big 1 or 2 years ago. Private credit, oil and gas, life insurance. As someone who runs an actual hedge fund see those structures up close, how should a doctor think about NURP versus those vehicles?
It obviously is completely different than those types of vehicles. Private credit, you're usually looking to achieve 8 to maybe 14% a year with different risk levels, depending on which industry that they're investing in. Insurance, generally around the same thing. A lot of those investment vehicles you just mentioned are typically right around like the 8 to 14% range. All of them are kind of talking about the same type of performance, but just in different ways and in different industries. And I would say our strategies are a bit more aggressive than that. But the cool thing is for the user that's actually using the strategy, you can go into our portal and you can make it more conservative. So if you didn't want to be as aggressive, you can tone down your own settings on the system. So you're using the default, it comes programmed with default settings based on history, by the way. This isn't just like I stared at a chart and I just decided to program this into an algorithm. This is all based on statistics and math. So we have 15 years of testing on the strategy that proves that the strategy, at least historically, over the last 15 years, according to back testing that we've ran on the strategy, and then forward testing with the live account, that it does have something called positive expectancy, which means that it makes money. So the strategy is unique because you can go ahead and be more conservative. If you wanted to shoot for the private credit type return of 14% a year, you could shoot with that and have your liquidity. That is the key. I would say the key thing is, number one, it has the ability to dramatically outperform. It doesn't guarantee that it outperforms. No one can guarantee any type of return, but it has the ability to greatly outperform something like private credit or real estate. And then secondarily, you have liquidity. And that's always been really important to me. When I invest into something, if I give up my capital here, how long does it have to sit in that investment? And so oftentimes it's years. And I don't know if you've seen the headlines. I read another one last night, but like Blue Owl and all these big private credit funds, you can't pull your money out anymore because they have something called a gate, which means that if the investors request over a certain percentage of their money back, the fund says no more withdrawals. No one can take their money back. So that their gate was apparently 5%. And right when they hit the 5% mark of 5% of the people requesting their money back, as far as the total AUM, the assets under management, they said no more withdrawals. It's to be determined when people would actually get their money back from that. And then if you're investing into something like private credit or real estate, sometimes they're placing that into an illiquid vehicle. They're giving that to a business. They're putting it into a property. You can't sell those things quickly, even if the fund wanted to give you your money back. So that's the difference. You're depositing your liquid cash into a brokerage account, and you can withdraw that money at any given time. We don't have control of your funds. You're in control of your own funds, and you can deposit and withdraw at any point in time that you want to.
The next question I have for you is, walk us through the structure. You have verification, capital staying in the member's own brokerage account, API only access. How does NURP prove the performance is real, that a member's money stays under their own control?
So like I'm mentioning, you can select almost any broker that works with a few different tech providers. So there's really hundreds of different options that you can choose from. And that's how you know it's real. Number one is you can see the strategy's performance online through a third party called MyFXBook, which pulls all of the data from our brokerage account and shows you every single trade since inception. We also got that all those brokerage accounts we sent to another third party that verifies this types of performance professionally, named Alpha Performance Verification Services. And we sent the brokerage statements to them, and they verified that, yeah, those statements match up with the performance shown through the other third party, which is my FX book. And then they also are being shown inside of our client portal. So you can see each trade there. And a lot of our clients, they come from relationships. People have a good experience and they just refer other people in. And then a lot of the times too, like with you, if you want to see the strategy perform first, I don't blame you. I think it's a good idea. So we'll give you a demo account. It's a paper traded account, and you can trade that account just with fake money. You can put 50 or 100 grand of fake money in there, and you can follow the strategy. And then you can watch our live performance, which updates usually on a daily basis. So it's all public information. You can watch that live performance online, and then you can see your account doing what the strategy is that's online, and you can see all of the trading history and match it up. So that's the best ways to verify that. And we have a demo based program where you can come in and test the strategy for a certain period of time.
How can people connect with you and learn more and find and check it out, see whether or not it fits in their strategy?
The easiest thing to do is there should be a link below somewhere in the description. There's a link below that you could click on. And then if not, you can also go to just our website. There's a way to book a call typically on there. In the top right-hand corner of the website, you can just click book a call or schedule or something like that. And you should be able to speak with us relatively soon.
Excellent. Well, thanks so much for coming on, and really enjoyed talking with you.
You as well. Thank you.
Let's zoom out. If you're a physician, founder, or high-income professional, and you feel like you're working harder every year, but not structurally freer, you're not alone. The mistake isn't effort, it's architecture. This show exists to help you convert expertise into scalable leverage, faster and with fewer expensive missteps. Here's the diagnostic I mentioned before. If your income requires your constant presence, if your capital isn't compounding outside your profession, if your highest value talent is doing low value tasks, you don't have a growth problem, you have a leverage design problem. And if you want to fix it with clarity instead of guesswork, I offer a limited number of one-on-one leverage strategy sessions each month. We audit your income model, capital deployment, authority positioning, and structural bottlenecks, and design your highest return move. If you're serious about compressing years into months, the link to apply is below.